When you consider investing $10,000 into a company that has multiple shareholders, you are not simply buying a piece of paper or a digital entry in a brokerage account. You are effectively purchasing a proportional claim on a living, evolving economic entity whose value is shaped by its financial performance, governance structure, strategic decisions, and the broader environment in which it operates, and therefore understanding how such a company is constructed, how ownership is distributed, and how value is created and preserved becomes essential before you commit your capital. To begin with, a company with multiple shareholders is typically structured as a corporation or a limited liability entity, where ownership is divided into shares that represent fractional claims on the company's assets and earnings, and these shares may be publicly traded on stock exchanges or privately held among a defined group of investors. And the distinction between public and private ownership already introduces a significant difference in terms of transparency, liquidity, and regulatory oversight, because public companies are required to disclose extensive financial and operational information, whereas private companies may provide only limited insight. As a small shareholder entering such a structure, your rights and influence will generally be limited, since voting power is proportional to ownership and large shareholders or institutional investors often have a dominant voice in major decisions. Yet this does not mean your position is insignificant, because even a small stake entitles you to certain protections, such as voting on key matters, receiving dividends if declared, and benefiting from capital appreciation if the company grows in value. And therefore one of the first aspects you must carefully examine is the shareholder structure itself, including who the major shareholders are, whether there are controlling interests, and whether management holds significant. Closely related to ownership structure is corporate governance, which refers to the system of rules, practices, and processes by which the company is directed and controlled. And in evaluating governance, you should consider the composition of the board of directors, the independence of its members, the presence of oversight committees such as audit and compensation committees, and the general transparency of decision-making, because strong governance frameworks tend to reduce the risk of mismanagement, fraud, or decisions that disproportionately benefit insiders at the expense of minority shareholders, whereas weak governance can expose you to significant risks even if the company. Another foundational element to analyze is the company's business model, which essentially describes how the company generates revenue and profit, and this involves understanding its products or services, its target market, its competitive positioning, and its sources of competitive advantage. Whether those advantages arise from proprietary technology, strong branding, economies of scale, regulatory barriers, or network effects. And the key here is not only to understand what the company does, but to evaluate whether its business model is sustainable over time, particularly in the face of technological change, evolving consumer preferences, and competitive pressures, because a company that thrives today. From there, your attention should naturally extend to financial analysis, which forms the backbone of investment decision-making, and this involves a careful examination of the company's financial statements, including the income statement, balance sheet, and cash flow statement, each of which provides a different perspective on the company's performance and health. And rather than looking at isolated numbers, you should analyze trends over multiple years, paying attention to revenue growth, profit margins, cost structure, and consistency of earnings, as well as the relationship between accounting profits and actual cash generation, because a company that reports strong profits but weak cash flow may be engaging in aggressive accounting practices or facing underlying operations. In addition to basic financial metrics, you should also evaluate key ratios that provide insight into profitability, efficiency, liquidity, and solvency, such as return on equity, return on assets, operating margin, current ratio, and debt-to-equity ratio. And these ratios help you understand how effectively the company uses its resources, how well it manages its obligations, and how much financial risk it carries, especially in terms of leverage, because while debt can amplify returns in good times, it can also magnify losses and increase the risk of financial distress during downturns, making it essential to assess whether. Equally important is the concept of valuation, which addresses the fundamental question of whether the price you are paying for the shares is justified by the company's intrinsic value, and this requires comparing the company's current market price to various valuation metrics, such as price-to-earnings ratio, price-to-book ratio, and enterprise value to EBITDA, while also considering growth expectations and industry benchmarks, because even a high-quality company can be a poor investment if its stock is significantly overvalued, whereas a moderately performing company might offer attractive returns if purchased at a sufficiently low price, and therefore valuation is not just Beyond the numbers, you must also assess the qualitative aspects of the company, particularly the quality of its management team, as leadership plays a crucial role in executing strategy, allocating capital, and navigating challenges, and this involves examining the track record of executives, their experience within the industry, their communication with shareholders, and their approach to risk and innovation, because capable and trustworthy management can create value even in difficult conditions, while poor leadership can destroy value despite favorable market conditions. The industry and macroeconomic environment in which the company operates also deserve careful consideration, as no company exists in isolation, and factors such as economic growth, interest rates, inflation, regulatory changes, and geopolitical developments can all influence performance, sometimes in ways that are beyond the company's control, and therefore understanding industry dynamics, including competition, barriers to entry, supplier and customer power, and the potential for disruption, allows you to place the company within a broader context and evaluate its resilience and growth potential under different scenarios. Risk assessment is another critical dimension of your analysis, and this involves identifying both company-specific risks and broader market risks, including operational risks, financial risks, regulatory risks, and reputational risks, as well as external shocks such as economic downturns or technological disruptions. And rather than trying to eliminate risk entirely, which is impossible, the goal is to understand the nature and magnitude of these risks, and to determine whether the potential returns adequately compensate you for taking them, especially given your personal financial situation and investment horizon. Liquidity is also an important factor, particularly if you are investing in a publicly traded company, because it determines how easily you can buy or sell shares without significantly affecting the price. And highly liquid stocks offer flexibility and ease of entry and exit, whereas illiquid investments may lock your capital for extended periods, or require you to accept unfavorable prices when selling, which can be especially relevant if your financial needs change unexpectedly. Another aspect to consider is dividend policy, which reflects how the company distributes its profits to shareholders, and some companies pay regular dividends, providing a steady income stream, while others reinvest earnings into growth opportunities, potentially leading to higher capital appreciation. And your preference between these approaches should align with your investment goals, whether you prioritize income, growth, or a balance of both. And it is also important to assess the sustainability of dividends by examining payout ratios and cash flow coverage. Legal and contractual protections should not be overlooked, particularly in the case of private companies or special investment arrangements, where shareholder agreements, voting rights, exit provisions, and minority protections can significantly affect your position. And understanding these terms ensures that you are aware of your rights and obligations, as well as any limitations on your ability to sell your shares or influence decisions. And it is often advisable to review such documents with legal or financial professionals before committing your funds. Furthermore, transparency and reporting practices are key indicators of a company's reliability and accountability, as companies that provide clear, consistent, and timely information enable investors to make informed decisions and build trust, whereas those that obscure or delay disclosures may raise concerns about governance or underlying performance. And therefore, paying attention to the quality of financial reporting, investor communications, and external audits can provide valuable insights into the company's integrity. As you integrate all these elements, it becomes clear that investing is not about finding certainty, but about making informed judgments under uncertainty, and therefore diversification should also be part of your broader strategy, as allocating your entire 10,000 into a single company exposes you to concentrated risk, whereas spreading your investment across multiple assets or sectors can help mitigate potential losses, even though it may also limit the upside from any single investment. Finally, you should align your investment decision with your personal financial goals, risk tolerance, and time horizon, because a company that is suitable for a long-term growth investor may not be appropriate for someone seeking short-term gains or income stability, and by clearly defining your objectives and constraints, you can better evaluate whether a particular investment fits within your overall portfolio and contributes to your financial well-being. In conclusion, ensuring that your investment is beneficial requires a comprehensive and thoughtful approach that combines quantitative analysis, qualitative judgment, and strategic alignment with your personal goals. And while no method can guarantee success, a disciplined evaluation of ownership structure, governance, financial performance valuation, management quality, industry context, and risk factors can significantly enhance your ability to make sound investment decisions and to navigate the complexities of participating as a small shareholder in a multi-owner company.